A very warm welcome to you, and thank you so much for joining us this morning for the Net Group Investments National Budget Speech Post Analysis. I'm Dumisha Greater. I'm an investment analyst here at Net Group Investments. Well, as you saw yesterday, the South African Finance Minister Enoch Godongwana tabled his first national budget, which really didn't contain any significant surprises. The government has been committed in wanting to restore their public finances, and this really has been supported by better than expected revenue collection. In fact, we can expect a primary surplus to be achieved in the years 2023 and 2024, and the consolidated budget deficit is also projected to narrow to about 4.2% of GDP. Meanwhile, gross debt is also set to stabilize around the years 2024 and 2025. So certainly yesterday we did get some breathing room in terms of the taxpayer. However, as highlighted by the Finance Minister yesterday, there's still some concern, especially when it comes to the matter of our debt, which is something that the Minister did highlight there. Well, how did the markets react in terms of what we saw in the local currency ahead of the budget and during the course of the day post the budget? We were trading around that 15 Rand mark to the US dollar. We did however, see the local unit weaken a little bit to about 15 Rand 08. This was just before the closing of the BAL. But of course, this morning, it is a very different picture because of those geopolitical tensions that have escalated between Ukraine and Russia. The local unit currently trading at around 15 Rand 25. In terms of the local bond market, there was some weakness that crept in. We were sitting at around 9.1% in terms of the SA 10-year, and by the end of the trading session at 9.2%. And again, this morning we're sitting at 9.4%, bringing in those geopolitical tensions again to the fore. But to help us get a closer understanding of the numbers and to ascertain what market participants should really be thinking about when it comes to these numbers, we are joined by the chief economist from Nedbank, and that is Nicky Weimar. Nicky, thank you so much for making the time to join us today. I know that you have prepared a presentation for us. National Treasury has positioned this particular budget as one that would help support the economic recovery while also wanting to build for the future. So just before I hand over to you, I hope at the end we'll be able to answer the question, can South Africa in fact rebuild? Over to you, Nicky.
Hello, everybody. Yes, it's great to be here. I think you've got already the summary of the budget in a nutshell there. In any case, let's have a look at this year's budget. It really was an attempt to search for some kind of balance. And what they're trying to balance really is this desperate need to reduce the deficit and at the same time at least meet to some extent rising social demands. So within this context, let's try and unpack this budget and have a closer look at it. Now, the reality of the situation is that it's always good to remember that ultimately government's ability to provide services to the public is really a function of the performance of the economy. It is intrinsically linked and also constrained by the performance of the economy. Now, on this front, what I show you here in red, there is the inflation-adjusted size of the South African economy, and in green, those little bars are your year-on-year growth rates on a quarterly basis. Now, as you can see, the good news on this front is that South Africa is in the process of recovering from the devastation caused by really level 5 lockdown. That's where all the damage was done. And since then, we're in the process of recovery. We haven't had the most convincing recovery out there, but to be honest, we haven't had the worst either. And the reality is that it's been a very stop-start recovery. It's been a function of really every successive wave of COVID infections and the tightening of lockdown restrictions. That's what's been behind the stop-start nature of this recovery. And obviously in the third quarter, we had to absorb a whole bunch of shocks, which was quite unique in terms of the fact that we also had to deal with really the destruction caused by July's riots and looting, troubles at Transnet after the cyber attack that affected the processing of cargo at the ports, and let us not forget, throughout all of this, consistent, seemingly never-ending power outages. So given all of that, the economy has actually staged a relatively good recovery in terms of the fact that it had to deal with so many shocks, had to absorb so many shocks. And you can see that we are almost back to pre-pandemic levels. We're not quite there, 98% more or less of 2019's levels, so almost back. Now, National Treasury largely anticipated this outcome, so there was no surprises as far as that's concerned. There you see in the first little graph, you see in fact our forecast, you see their forecast in February 2021, in the mini budget last year, and then again the latest set of forecasts is there in yellow. And there's been no dramatic changes to the outlook for the economy going forward, very similar stuff. Last year, in October, they thought the economy might grow by 5.1%. At the end of the day, it grew by 4.8%, or is anticipated to grow by 4.8%. Slightly worse than they thought in October, but a lot better than their initial estimate, which was extremely conservative of about 3.3% for last year. And then going forward, they're looking for about 2% growth this year, and then 1.6 and 1.7% in the following 2 years. Then the next little slide there just shows you that they are very much in line with market expectations. I show you our particular forecast for the economy going forward. I show you the Reserve Bank's forecast, and I show you National Treasury. So on the economic front, really, as far as National Treasury is concerned, the economy responded the way they thought it would. So there were no major surprises. Of course, we knew going into this year's budget that in reality, government's revenue were going to be a lot better than they budgeted in February last year, and it was even going to be higher than their adjusted estimates that they put out in the mini budget or in the medium-term expenditure framework of last year. And the reason for this is that government revenue was supported by this resurgence in corporate income tax, which was itself a function of a rebound in exports, particularly mining exports. And here you can see the story I'm talking about. I show you the trade balance. Look at that green line there, how exports just pulled away from imports. And as a result of that, for the last 2 years, we've been running a sizable and significant trade balance, so much so that it turned our current account into a surplus. So this is where the boost came from. And of course, that rebound in exports was, of course, a function of a strong recovery in the global economy. And the world economy rebounded strongly, global demand recovered, and very importantly, COVID-19 and lockdown resulted particularly in a surge in demand for goods. So it's the goods economy that rallied, not services, goods. Services were disproportionately affected by lockdown restrictions. And what happened all over the world is that consumers that could no longer go to the salon, could no longer go to the gym, could no longer go on holidays, redirected that share that they used to spend on services, that share of their wallet, they redirected all of that towards goods. So there was this enormous surge in goods, and it was amplified, of course, by aggressive fiscal and monetary policy support in many of your advanced countries. And that little graph on the one side shows you the GDP performance of your major economies. We've indexed it to 2019, which is just before the pandemic struck. And you can see that most countries, most major economies, are now, in fact, either back at 2019 levels or above 2019 levels. But you can also see that over the last couple of quarters, all of those lines are starting to drift sideways. So growth is starting to moderate. Nonetheless, it was a convincing rebound. It was a strong recovery. And the biggest feature here that South Africa benefited from was that surge in demand for goods. And that, of course, is what drives demand for commodities. And so what we saw is that commodity prices just surged, and particularly those commodities that South Africa is a big exporter of. So you can see their metal prices, look at that, precious metals, they've been the top performers out there. And that's where the surge in corporate income came from. So a nice little windfall gain, but not something you can necessarily rely on persisting over the next couple of years. So we can think of it really in terms of a windfall gain. And as a result of that, there's no denying we all knew that the outcome of your budget will be a lot more favorable. Your fiscal metrics will look a lot better because of that resurgence in revenue, particularly corporate income tax, during the course of last year. And this really is the budget in a nutshell. There I show you revenue, I show you the percentage change in revenue, I show it to you as a percentage of GDP, then I show you expenditure, the exact same measures, and then ultimately the deficit. And if we just concentrate for a moment on the fiscal year that has passed, which is 2021-22, you can see what we're referring to. In February 2021, government expected revenue to grow by 11.6%. At the end of the day, it grew by 22.4%. So that made all the difference. Interestingly enough, again, expenditure was higher than they anticipated. In February last year, they wanted to cut expenditure by 1.6%. At the end of the day, it grew by 5.7%. And then you can see as a result of that resurgence, mainly in revenue, it brought the deficit all the way down to 5.7%, where at one point they feared that we would in fact still have a deficit close to 10% of GDP. So that was last year. Now going forward, you can see what the plan is. Revenue is anticipated to grow 2.9%, 4.7%, and then accelerate up to 6.7% by the time we get to 2024-25. But here's the key of this budget. It is hoping to install great expenditure constraint. We'll return to this point, but it's hoping to do that. You can see expenditure set to grow by only 3.9% in nominal terms this fiscal year. Then they're going to slow it all the way down to 0.9%, and then they'll let it go up to about 4.8%. Now, if you assume inflation of 4.5% throughout this period, you are in fact talking about real cuts in government expenditure. So in real terms, they aim to cut expenditure. And that brings you to a situation where this year the deficit actually goes up 6% of GDP. Then they hope to bring it down a little bit faster than they initially planned in the medium-term expenditure framework to 4.8% next year, and the year thereafter down to 4.2%. Now, it is important when we look at these numbers. It's been generally well received. Everybody's pleased that they're going to reduce the deficit at a slightly faster pace than they reflected in October last year, and certainly than they reflected in February last year. But here's the thing. We've gone from a situation where we feared the worst, where we in fact feared a frightening outcome, to just getting a bad outcome. Those deficits are still unsustainable. They are still adding to your debt burden at an unsustainable pace. And so your debt burden continues to climb. Here is government debt as a percentage of GDP. I show you all their estimates over the years and the different budgets, and then the bars represent this particular year. And you can see that it's better than they thought in February last year. It's certainly better than they thought in October even, only slightly so, but nonetheless better. And they see it sort of stabilizing at 75% of GDP. As we dig into this budget, you will come to realize that estimate is highly uncertain. And the reason it's highly uncertain relates not so much to revenue, but almost entirely to the expenditure estimates. And we'll chat about that as we proceed. So the deficit is still an issue. You're still over 3%. You're still adding to your debt burden at an unsustainable pace. And to this overall debt burden, you've got to add the debt of state-owned enterprises that government guarantees, which is your so-called contingent liabilities, and the debt picture still looks ugly. Here, the biggest risk, of course, comes from Eskom, but by no means is Eskom the only state-owned enterprises in a difficult situation with a burden of debt and stuck in a very desperate financial position. So all state-owned enterprises are very much vulnerable, and therefore the threat to government of having to honor those guarantees remains significant. You add that to the debt burden, and you've got your debt stabilizing at a much higher level, which is 90% of GDP. So that doesn't sound so good anymore. That doesn't sound so attractive anymore. So this is the bigger picture. Now we're going to delve into the actual tax proposals, and we are going to delve into the expenditure side of the budget. So on consolidated revenue, there you go. I show you that little table on the side, and you can see that government is aiming to grow this year revenue by 2.9%, then 4.7%, then 6.7%. Now that's all very doable. Your nominal GDP is going to grow by more than that, based on our estimation. So they should get support from essentially GDP and also from inflation. And so the economic recovery should make that easy to achieve. So they've been very conservative in their revenue estimates, and you could say they're trying to be as realistic as they possibly can. Tax revenue, I showed you that to you next. To consolidated revenue, that is an increase of 3.3% this year, and then up to 6% and 6.7%. So this now aligns a little bit more to the growth in nominal GDP. So the reality is, where are they going to get that revenue from? Okay, so in South Africa, we get 30%, 37%, almost 40% of tax revenue from taxes on individuals, personal income tax. Then we get a sizable portion from companies, 19%, and then we get 27% from indirect taxes raised primarily through VAT. Now, the others are all marginal. They contribute, but they are not the chunk. You can see the chunk is personal income tax, then it's VAT, and then it's company taxes. So that's where we usually get our resources. And in 2022-23, that composition really remains largely unchanged. The only one that shrunk from last fiscal year is, of course, company taxes. So what are the sort of growth rates we are talking about? What have they projected? What are they budgeting for? And you can see over the next 3 years, everything moderates. All sources of revenue moderate. And they grow more or less in line with nominal GDP. That seems to be the estimates they've put out there. And you can see they're going to rely predominantly still on VAT and individual taxes to do the heavy lifting. They're not expecting much in terms of company taxes this year. After that enormous surge, 54% up during the course of last year, from that high base, they anticipate that they will get less from company taxes. They also anticipate that because they've cut the company tax rate, which has been a very encouraging and positive feature of this particular budget. And then they expect company taxes to grow slowly, 1.9, 4.3%, so less than the rate of inflation and less than the rate of growth in nominal GDP. So it's VAT and individual taxes that will do the heavy lifting. Let's now have a look at our tax proposals. Okay, so what did they do for us this year? They effectively gave tax relief of 5.2 billion rand. Listen, they did not have a lot of scope because, as I told you, they are still running deficits of over 3% of GDP, and that debt burden continues to climb, only stabilizing at around 75% of GDP by the time we get to 24-25 and 25-26. So there's still a big job to do as far as fiscal consolidation is concerned. That leaves them with very little room. Nonetheless, they provided 5.2 billion. In terms of direct taxes, that's where they provided relief of 2.2%, and then you can see the breakdown of that. What they did for individuals is, of course, they adjusted the income tax brackets to compensate for the effects of inflation, so that when you get an increase, you don't get bumped up 1 or 2 levels to a higher tax bracket that completely erodes your increase in your income on an annual basis. So they made that adjustment. They expanded the employment tax incentive. That gives back 2.2 billion rand to the economy. And then the big one, of course, is that they reduced the corporate income tax to 27% from 28%, and that gives back 2.6 billion to the economy. But for companies, they are also going to apply a lot stricter rules. They are going to restrict the amount, they're going to place restrictions on assessed losses, making it a lot harder for companies to put losses through. And they are also going to put limitations on additional interest deductions. So there you go. That should bring them back. Those stricter rules should give them back 1.1 billion and another 1.5 billion. On indirect taxes, there were no adjustments to the fuel levy. So in essence, they're giving you back 3.5 billion. And then, of course, there was the normal sort of inflation-related adjustments to your excise duties, or the common term for that, your sin taxes. So that's it. That is the tax proposals, all of them wrapped up. Not a huge amount happening there. As far as company taxes is concerned, it's very encouraging, and probably the most positive feature of this budget is that they reduced the company tax rate from 28% to 27%. Now, there might be very many people on the left side of the political spectrum that might criticize this move. But this is the context. The context is that South Africa's corporate tax rate is high. It's high by global standards, it's high by emerging market standards, it's high by African standards. So if we now get that reduction, which takes us to 27%, we are now more in line with corporate tax rates in Chile and in China and in Latin America than we used to be. All right, so it was a good move, and it brings us more in line with the rest of the world. We're still well above the global average, by the way, well above it. But we are at least more in line with some key emerging markets. On the tax front, listen, on a personal income tax front, listen, it's very marginal stuff. We've been given some relief. I think that's the good news. Here I show you your absolute tax savings. So what you need to do here is you need to go and find your taxable income, which is, in the case of this audience, everybody earns 2 million and above. So you just need to look at that top bar. And then this bar shows you, the dark green one shows you your absolute tax saving in the year. So if you earn 2 million and above, your absolute tax saving over this year is 7,862 rand. As a percentage of your income, it is fractional. It's only 0.4%. And in fact, that's been the situation. They targeted the relief at your lower to sort of middle income groups. You can see 500,000, they got 0.7% relief relative to their taxable income. Equally, those earning 100,000, they got 0.7%. And that's the max. So it's all very marginal stuff, and really it's just compensation for the effects of inflation. Now, as far as individual tax rates is concerned, South Africa is simply off the charts, all right? There you go, South Africa at the very top, 45% top marginal tax rate, way above the African average, way above the global average. So we're very unique as far as that's concerned. This is an economy that has an incredibly progressive tax system, regardless of what anybody might say. And I think that's the perspective to bear in mind when you hear these calls for increased taxes, when you hear these calls for greater social assistance to the public. Now, as far as indirect taxes are concerned, you can all get a copy of this presentation. I'm not going to go through all of them. There they are, though. That's what's going to happen to the tax rates. The one is what it was last year, and the one what it will be increased to. And then you see the percentage increase in nominal in real terms. And you can see for most of them, you are talking about a real increase in indirect taxes or excise duties of between 0.97% and about 2%. So that's what we're talking about. Above inflation increases, but they've been limited to a max of about 2%. The highest one there is on cigars, and that's a real increase of almost 2%, 1.97%. Right, so indirect taxes, and this is the interesting thing about South Africa. It has a lot to do with our history, with the legacy of discrimination, with the outcomes of apartheid, but without a doubt, we have this complete complex against relying on indirect taxes. So our indirect tax rate is very low by global standards. There you go, South Africa, we're below the global average, below the African average, and look at all the emerging markets that almost predominantly rely on indirect taxes as a source of government revenue. And the reason for that is that you spread the tax burden very wide and you broaden your tax base. So that just gives you a sense on the tax side where we are. Very marginal relief. The most positive outcome there has been the reduction in corporate income tax rates. And even on that front, it just simply brings us more in line with the global average than we used to be. Right, so let's now turn to expenditure. Now, when we look at expenditure, this budget assumes, as I said before, that we are going to see considerable expenditure restraint. They are budgeting for consolidated government expenditure to increase 3.9% this fiscal year, or the fiscal year ending 2023, February 2023, and then they are budgeting for a slowdown in that to 0.9%, and then up to 4.8% by the time we get to 2024-25. Here's the thing though, look at the history here. Government has never succeeded in restricting expenditure to these sorts of levels. And like I said before, it's below the rate of inflation. So in real terms, in inflation-adjusted terms, we are actually talking about real cuts in expenditure. Now, their history in achieving this is not good. Okay, it's simply not good. And expenditure has this habit of always exceeding their budget targets. And in the budget, the minister actually acknowledges that, saying that the expenditure ceiling has not been as effective as it should be, and that they are re-evaluating that process to ensure that there is greater discipline in spending. Right. And it's going to be exceptionally tricky. And the reason it's going to be exceptionally tricky to restrict overall expenditure to those modest growth rates is because state debt cost is going to continue running away. And that is why the deficit matters. Those that say, and there are lots of people at this point, even, economists that are calling for us to increase government's deficit, to not worry about the deficit, to go out there to provide a basic income grant and to provide some basic form of support to the majority of the population. But deficits do matter, and they do matter because you have to finance them. And you're adding to your debt burden, and it's a cumulated effect. And as a result of that, your debt service cost starts to run away. All right. And so this is going to be, look at that red bar, that is the growth in debt service costs. It's just frightening. It's the fastest growing item in the budget. This fiscal year, it's going to grow 12.5%. And then as they try and cut the deficit, it's going to be contained to 11% to 8.5%. So this is very sensitive to the deficit and to how much you add to your debt burden and at what rate. But because it's growing at double-digit rates throughout the next 3 years, it means they have to actually cut non-interest expenditure. So what's happening here? Because you're running deficits, because you've not been disciplined in that front, you're now forced to cut spending on the things that really matter, on the things that really make a difference to the economy's potential growth rate and certainly to the services that are essential to the public, like social services, education, and so forth. So in many ways, debt can be very destructive if it is not put to good use. And we have not put it to good use. We have used it for consumption expenditure. And the whole problem with the argument for a basic income grant is that you want to take on even more debt to finance consumption expenditure. And that's not the answer, because that's what's going to happen to your debt service cost. It's just going to eventually crowd out all other forms of expenditure. So they're going to have to contain non-interest expenditure to 2.6%. They're going to have to cut it in 2023-24 to by 0.7% in nominal terms, so a steep cut in real terms. And then they are foreseeing that they can possibly grow it by 4.2%. Just to add to my whole argument against debt service cost. By the time we get to 2025, debt service cost will eat up, will consume over 20% of our tax revenue. So that's the problem with that argument. It's almost like a catch-22. You think you're supporting the public, but because you have to finance that through debt, at the end of the day, that debt service cost just essentially erodes all your spending power. All right. Then the other key thing that these budget expenditure targets rely on is that government will succeed in containing the wage bill. All right. So this is the growth they are foreseeing for the public sector wage bill, only 2.6% this year. Inflation currently running at 5.7%. So in other words, they want to cut civil service wages in real or inflation adjusted terms. And in that, they are set for a battle with the unions. Then, in nominal terms, they want to reduce it in 2023-24, all right? And then they will allow for growth of slightly below inflation of around 4% by the time we get to 24-25. Now again, history does not support government's power or ability to control the public sector wage bill. They managed to do it in 2020, 2021 when they had a wage freeze. They did not. The bill was once again higher than they thought it would be in 2021-22, which is the fiscal year that has just passed. But yeah, let's just say 4.8% given their history is not a bad performance. But it's all going to come down to this. And here's the thing. The 2020 wage freeze is currently at the Constitutional Court, and we are waiting for that outcome. If the court rules in favor of the unions, that's going to result in a lot of additional expenditure for government, which they did not budget for. Added to that, they haven't got a wage deal for this year, for next year, or the year thereafter. And the unions are not willing under these circumstances to commit to a 3-year wage deal. So every single year we're going to be renegotiating this wage deal. So this poses huge upside risk to the expenditure outcome, and it poses huge upside risk to that budget deficit they've put out there. So incredibly uncertain. There's no reason to feel comfortable about this or certain that that outcome will transpire. Right. So we've dealt with debt service cost, we've dealt with non-interest expenditure, we've looked at the public sector wage bill. What are they going to spend the rest of the money on? Okay, so you can see this shows you each type of spending's share of government's total expenditure. And you can see that the bulk of government spending goes towards education, social protection, healthcare, and something called economic affairs, which is a broad base of different functions. And then public order consumes 7.7% of government expenditure, and then everything else is very, very tiny. All right, so what are they going to do? Over the next fiscal year, the biggest growth rates are going to be in housing and environmental protection. And environmental protection, of course, includes a lot of the energy initiatives, a lot of the reforms in the energy sector, and also our commitments towards COP26. So very little, very encouraging development. Rather, they're going to grow that by much more than the rate of inflation in the year ahead, which is 12.6%. Housing, again, there is a big drive there to add housing infrastructure, and a big portion of that is, in fact, infrastructure spending, and that's going to grow by 14.2%. But these are not big functions in your overall spending. Let's just go back to the previous slide. Environmental protection, remember, only makes up to 0.6% of government's total expenditure, all right? Housing, where is it? It's only 1.8%. So yes, they're growing it by a lot, but it's a tiny budget vote. Then it's education, more than the rate of inflation, 4.6. And then under social protection, that's going to grow by less than inflation, 3.7. So they are going to extend the social, the SDR grant for another year up until March 2023, but they're cutting everywhere else. That's been the outcome. All right, so that puts that in perspective. Here you go. This is the breakdown of social welfare. It's dominated by the extension of the SDR grant. You can go down that list and you can see how much they will spend on every type of welfare support. I think the more frightening thing for people is really the amount of people that are currently receiving some kind of handout. Last year, it was over 18 million people. And the anticipation is that it will continue to grow. And by the time we get to 24-25, you will have over 19 million people on some form of government support. Now, within that context, you want to provide a basic income grant. It is simply not affordable. Also, added to that, you already have significant support measures just contained in this slide. And so that is the perspective, I think, to the basic income grant. All right. Then what about the next 3 years? So this fiscal year, it's going to be environmental protection, it's going to be housing, and it's going to be the extension of the SDR grant that will dominate government spending. Over the next 3 years, where will the focus go? Again, to those tiny categories called housing, environmental protection, and then everywhere else, they're actually going to cut spending. This is the average annual growth rate. Almost all of them are less than inflation. So this expenditure restraint isn't just for this year. They're going to have to keep it up for next year and the year thereafter, and probably even beyond that. So it's a difficult challenge, an enormous challenge they have ahead of themselves. The other thing that they made a lot of in both the State of the Nation address and in the budget yesterday is, of course, infrastructure spending. Now, during this period where the budgets were growing, where the public sector wage bill was growing, where social support was growing, and where all government's resources was really directed towards consumption expenditure, the way that they made that possible was not only by borrowing, but also by cutting capital expenditure budgets to their bare minimum. Now they want to reverse that because the country's infrastructure is literally falling apart. And the pandemic made all of that worse. As we've seen, many of the rail stations, many of the rail network has been looted, has been damaged. It's an enormous job just to get it back to where it was, and it wasn't in good shape before the pandemic. So now they want to redirect spending back towards infrastructure and infrastructure investment. And it's a big feature of President Ramaphosa's Reconstruction and Recovery Plan. It was a big feature of the SONA, and it is a big feature of this budget. But at Nedbank, we actually track capital expenditure projects. We've got a listing called Nedbank's Capital Expenditure Project Listing. We only track projects in the public domain. Obviously, we can't do anything other than that. When we get a capital project, we phone up the company, we ask them whether they're going to spend the money, and we do the same with government projects. And so we have a good sense of how much of this is actually going to happen, is actually happening, and how much is not, and what is its scale relative to the overall economy. So although the infrastructure allocations sound enormous, 249 billion rand for this year, 275 billion rand for the year thereafter, up to almost 290 billion in 2024. As a percentage of GDP, it is completely inadequate. Okay, it is going to be steady at 4%. So you're not growing it. As a percentage of GDP, you're holding it steady at 4%. So do not be fooled by this. This is not an acceleration. It is really just a maintenance of capital expenditure at 4%. All right. So that's a key point I wanted to make. Here's the detail. When you get a copy of this presentation, you can go through it. I'm not going to spend an enormous amount of time on it. It shows you what type of infrastructure they'll spend money on. Obviously, energy gets a lot. A big portion of that will not be undertaken by the state. It is actually part of the renewable energy program, which will be undertaken by private companies. Water and sanitation will be getting a lot of focus, and you can get a sense of where they're going to be spending their money going forward. Now, let's wrap up. Let's give you our assessment of this budget. Is it a good budget? Is it a bad budget? Listen, it's a lot better than everybody feared back in 2020, back at the start of 2021. A lot of the reason that it's better is really just that we got lucky. We benefited from the type of economic rebound we saw in the world economy, which was one associated with a resurgence in the demand for goods, which resulted in a wonderful upswing in commodity prices. Right? So we benefited from that. We got lucky. Government did show restraint, however, and I think they do need to be given credit for that. They showed expenditure restraint in 2020. They showed a degree of expenditure constraint in 2021, even though expenditure was at the end of the day higher than they thought or budgeted for. But they're going to have to show considerable constraint in the years ahead, and those expenditure targets are highly uncertain. They don't have a record of meeting the expenditure targets, and this year it is more uncertain than normal because they don't have a public sector wage bill agreement in place. And at the same time, of course, we've got all of this pressure, and the president himself said that they are looking at ways of providing long-term basic income support to the South African public. So that also is going to add to your expenditure bill and could easily be higher than they anticipated. How do we compare with the rest of the world? Well, with our budget deficit now at 6% of GDP, we're still on the high end among emerging markets. We are still very definitely on the high end, but at least we are in reasonable company. We don't stand out anymore, but nonetheless, we are on the higher end. But here's the important thing. We still stand out on debt. This compares South Africa's public debt burden to some key emerging markets. You see there, AC stands for advanced countries. Their debt a lot higher, but that is a different story and a topic for a whole different presentation. But you can see that as far as emerging markets are concerned, South Africa in the past fiscal year has been above the emerging market average. That's what we get compared to. And our direction of travel is wrong. Our debt burden continues to climb. And this year, it's anticipated that we will move up even further above the emerging market average. So we still stand out very, very significantly among emerging markets as far as the debt burden is concerned. So to wrap it up, it was a reasonable budget. It is a reasonable plan they've presented, and I think they're trying to put in place, they're trying to be the steady hand for the economy. They're trying to move the economy steadily and gradually towards a position where you have fiscal sustainability, or rather move government finances towards that position. They are reflecting considerable expenditure constraint. But there is an enormous amount of uncertainty to those expenditure targets. On structural reforms, all the reforms they have suggested are sound. If they were to be implemented, they will undoubtedly make a difference to the economy, and they will undoubtedly lift our potential growth rate. However, we do know from reports on the ground that progress has been bitterly slow. So we need a sense of urgency in order to deal with structural constraints. And the negative for me is just the fact that we are in a debt spiral. All right. Regardless of the fact that the deficit is better than we thought, that they are going to reduce it a little bit faster, we are in a debt spiral. Debt service costs will consume more and more tax revenue, and that is a very narrow tax base. And so those are our biggest concerns. And then on infrastructure, we actually need urgency, because we already sit in a situation in South Africa where our existing infrastructure is decaying and imploding and falling apart a lot faster than we can add new infrastructure. And so that remains almost a persistent, never-ending constraint on your economy's ability to grow faster. So overall, a reasonable effort. It certainly presents a more stable picture going forward. But underneath that, there are enormous uncertainties. Thank you.
Thank you so much for that, Nicky. Very much appreciated as always. I'd like to maybe start with a big issue, and that is around our debt. So you mentioned a couple of things in that our debt servicing costs obviously being the fastest growing expenditure item. So if we look at the debt servicing cost, for every 20 cents that or for every rand that we get, 20 cents then would be spent towards debt, which is concerning. So I think my question then becomes, is there any way to try and reverse this trend that that you are concerned about, especially when we take a look at what is happening with the macroeconomic factors? We've got rising inflation, oil prices have already been shooting up, and then we've also got interest rates that are going to start increasing as well. So is it realistic for us to be in a position to think that there is any way to reverse this?
There's no easy way to reverse this. The only thing you can literally do is, of course, you can cut expenditure even more dramatically, bring your deficit down quicker, and that will obviously make a difference because it will help you to stabilize your debt sooner, and that will help contain debt service costs. That's one thing you can do. That is very painful. All right, so elements of that's already contained in this budget. There's no denying that they acknowledge it exists, they acknowledge it's a problem, and they're trying to move us towards a better position where they can start to contain debt service cost. However, there's another way of doing it, and that you implement structural reforms quickly. You raise your country's potential growth rate. So growth is one easier way out of dealing with debt service costs, because if you grow, government revenue is a lot higher than you anticipated through taxes, and that helps you to bring your deficit down quicker and in a far less painful manner going forward. So there's only really two levers here. One is you cut expenditure in a dramatic way. The other one is you grow your economy, or you do both. All right. Now, if you can't boost government spending, you've got to rely on the private sector to do the heavy lifting, which means you've got to create an environment that is supportive, which brings us back to those structural reforms.
Nicky, then let's talk about the one lever that's got to do with maybe cutting. And now I'm talking about the public sector wage bill. So in the medium-term budget policy statement, the finance minister said that he'd allocated an additional funding of about 20.5 billion. This would be for the year 2022 and 2023 to meet the cost implications of the service wage bill. But what was interesting in this particular budget, he said something that that they would need to reduce personnel numbers to sustainable levels if they because they're not going to be wanting to increase the wage bill. You spoke about real cuts. Are you getting a sense that this time around the government is not willing to budge when it comes to increasing, costs in terms of their wage bill? Or is this again just the same story? History is likely to repeat itself, and we'll find ourselves in a situation where we've got, wage increases once again.
You know what I think is they are certainly committed to containing the growth in the wage bill. And I think they're putting out estimates there that they know they won't achieve. I think where we will settle, and it's almost like a psychological game with the unions. This is what we're aiming for. This is harsh. And so if you say we want to control the wage increase by 2%, it only increases by 2%. The way the unions go for 3.5%, you still in effect get a real wage cut. So I don't think they're going to meet the targets they've got out there. I think they know that. But their hope is that wherever it settles is only slightly above what they budgeted for. And, in the IMF article for consultation, they pretty much say that. They, in essence, say that. So that comes through very clearly. And so at the end of the day, I think the two parties will have to meet each other somewhere. And I think that it is probably going to be slightly higher than they budgeted for. But in terms of employment numbers, I don't think they'll retrench people. I think all it simply means is they cannot drive job creation. And that stands in stark contrast to what the president said under the SONA, where they aim to accelerate public sector employment as a form of support to the economy. So those two are inherently incompatible. They can't coexist. And I think the reality that will, at the end of the day, play out is the one presented by National Treasury, where staff numbers remain constant and you've got a wage increase slightly above what you budgeted for.
There were two scenarios that were outlined in the National Treasury when it comes to the growth outlook. And I think they do this every time or twice a year when we do have the budget that comes out. So the upward scenario in terms of growth surprising on the upside. Again, they mentioned reforms and ensuring that we keep our debt in check. I just want to talk around the issue of reforms, as you mentioned, and ESCOM with the state-owned enterprises being one of them. They said that National Treasury for 2023, 2022, excuse me, and 2023, they'd be looking to publish a framework that would outline a criteria that government would be using when it comes to future funding for state-owned enterprises. I'm not sure I got a lot of clarity on that, Nicky. Maybe is this something you're able to shed a little bit of light on? Because is this, again, something that you see that is new when it comes to government's commitment in terms of reforms? I'm not sure how much information you may have been able to gather from that particular
I
reframing
think
and
it's
outlining in terms of funding structures.
No, I think it's very early stages. And again, it's that thing, we will do something about it. It's always the will do, the will do, the will do. These things should have already been finalized, in my opinion. You should understand the criteria and the parameters under which you are willing to provide support and bail out state-owned enterprises. But yes, the aim is to establish that. And clearly the idea would be that it would be stricter than has been the case in practice up to now. No, I don't have any additional information on that. And I also think that at the end of the day, what they said to the IMF is quite interesting and revealing. They basically said, listen, there might be a situation where we have to bail out state-owned enterprises, where we will have little choice. And you kind of have to accept that. So again, that's probably a little bit closer to the truth, what was said to the IMF. Okay.
And Nicky, I want to talk about some of the tax proposals. So you mentioned corporate taxes, which is great, a move in the right direction. If memory serves me correctly, I think it was back in 2020 when National Treasury had already started to say that they're going to be looking at corporate taxes and moving more in line with what we've been doing with what the rest of the world is doing. So past 15 years, as you've said now, on average, it's about 23%. We've only gone down by 1%. I think, do you think enough is being done to stimulate the type of environment that we need? You spoke a lot about job creation. So that is just the first point in terms of taxes. And secondly, there's a lot of talk, driving here, listening to the radio, listening to different interest groups talking about the sugar tax, for example, the fact that this is going to be implemented. And I think it was cane growers or South African Cane Growers Association who was saying, they want to be putting these taxes in place, yet we are going to be looking at job losses of about 16,000 people that are going to lose their jobs. So again, it's that balancing act that government has to have, increasing taxes, wanting to keep jobs. I'm just wanting to, to get a sense from you, is this just really sensationalism in terms of, journalism wanting to say we're going to be losing jobs here, we do need to have these job cuts, or, I don't know, how do you get that balance of creating the right environment, but ensuring that obviously you're doing it in a sensible way?
Yeah, so I mean, you're going to have that. I mean, it's the same with excise duties on luxury goods, whether it be luxury vehicles or cell phones. It will always be met with resistance. If you're a company, taxes directly impact the price of your product and therefore ultimately your sales. So you can understand where, sugar beverage producers come from and sugar producers come from. You can understand that. That is natural. Government's job, though, is to step aside from that and note the vested interest and make a sensible decision. And it's never going to be easy. But at the end of the day, if they were to introduce a sugar tax, would it result in massive job losses? I think it's highly unlikely.
Nicky, just before we go, I mean, we've got a couple of minutes to go, but I'd really just like to also use this opportunity to get your take, I guess, on the global environment. In the second example or the second scenario that was modeled by National Treasury in terms of the growth outlook, they mentioned the macroeconomic factors and rising inflation, etc. Can we just get a sense from you on how you view the inflation outlook? I suppose maybe looking at the global picture and all the factors that are in place, and how this is likely to spill over into South Africa's inflation trajectory.
Yeah, I think so. Globally, I mean, I've had quite a deep look, certainly at the situation in the US, and price pressures in the US. It's widespread. So I think a portion of that rise in inflation that has been caused by the pandemic, initially caused by transitory factors, the so-called famous word that everybody has dumped now, some of it will stick. You are certainly seeing it in things like house prices. You are seeing it across the board coming through in certain services. Services have really been affected by labor shortages. So there are all of these complications as the world economy emerges from the pandemic, emerges from lockdown, learn to live with it. It has caused all sorts of distortions that are manifesting itself in prices. And a lot of that's not just going to go away overnight. So yes, we are, I think, globally sitting with a situation where inflation will settle higher. Will we see it at the current acute levels where it is running extremely hot and well above central bank targets? No, there's a base effect here. And once that base has sort of been completely accommodated, what you will have is that from there prices will start to increase at a slower pace. And we should see towards the end of this year that price pressures start to moderate, right? And going into 2023 and move closer towards central bank targets. Can central banks ignore the inflation we've got at the moment? No, they can't. Because that's the thing. We have got a supply shock, all right? So in theory, if you're a central banker, you should look through supply shocks, all right? You should view them as temporary, you should look through it. Except when those supply shocks persist for a long time, or enter an economy where certain conditions prevail that could result in secondary inflationary effects. Now, as a central banker, that's where you should focus your attention. Now, what could result in secondary inflationary effects? What sort of conditions? Conditions where you've got strong growth, okay? So you've got a positive output gap, and conditions where you've got a tight labor market. Where does that apply? It applies 100% to the United States and have for some reason, which is why I think rightly so. The markets have been criticizing the Fed. They should have responded a long time ago. All right. They've got a surging economy. They've got no problem with demand. They've got labor shortages. They've got an extremely tight labor market that is going to produce the type of inflation we're seeing at the moment. And the Federal Reserve can't do anything about oil prices. They can't do anything about supply chains, but they can certainly do something about that second round effects. And so, yes, I think we're going to see the Fed start to hike interest rates a lot faster than they certainly indicated throughout 2020 and 2021. It might not be the aggressive picture some of the markets are punting, where you are talking about hikes at every single meeting for the next 2 years, but it's certainly going to go up, and it's going to go up at over 3 cuts this year. I've little doubt about hikes this year. Sorry, hikes, not cuts. That will have an effect on us. Now, here's the interesting thing. The Rand has, it's the naughty child of the foreign exchange markets. It's unpredictable. It's the teenager. It's got strange moods. No one knows where it's going. And I would certainly not stake my life on a Rand forecast. I value it too much. But the reality is that sort of environment where you have quantitative tightening, in other words, the US Fed, the ECB, the Bank of Japan start to take yen and euros and dollars out of the system. So there's a liquidity issue. And at the same time, higher interest rates tend to support a stronger dollar. That's what it does. And when that point comes, you would expect the Rand to come under fairly significant pressure. Okay, and you would expect the Rand to weaken. Okay, and so from the Reserve Bank's perspective, we do need a bit of a buffer. Our interest rates are still too low, and you need some protection given that you're a high-risk nation and you need to continue to attract capital inflow. So interest rates will continue to go up in the case of South Africa as well. The pace you could argue about, you could debate about, but the reality is interest rates are too low to provide that sort of compensation for risk, especially in this overall changing global environment, and therefore it will have to go up. But yeah, on the global front, it is an interesting place we are, an interesting situation we're in. There is another scenario here that is also something we need to bear in mind. Once the world is completely adopted or adapted to this pandemic, it's become endemic, and we have learned to cope with it and live with it. As we go into 2023, 2024, there is also a possibility that all of these price pressures, after you've started to tighten monetary policy, just evaporate. And really deflationary forces reassert themselves. And then you're in a total different ballgame altogether. Things like an aging population, all of those forces that have really dominated the inflationary story in advanced countries, that could also play out. It's not going to be this year, but when it arrives, it could happen quite quickly, where you could have inflation imploding off a higher base. So there are a couple of ways that this picture can play out. But I think at this point, we are undoubtedly in an inflation cycle. That's probably going to be the dominant feature of 2021, which means tighter global monetary policy, pressure on liquidity, and a much more volatile setting going forward.
Nicky, thank you so much for that. Always really do value your insights and the way that you always present the work and just make it a lot more digestible for everybody. Thank you so much. Of course, that was the chief economist at Nedbank, Nicky Weimar, taking us through the national budget for 2022 that was tabled by our finance minister yesterday, Enoch Godogwana. Just, we are 10 o'clock on the dot, but really, I suppose, just a few points that we wanted to highlight from the budget that Nicky has said, was one of the things was that, of course, we do have proposed structural reforms, but of course, they need to be implemented and accelerated. And of course, these are very important in order for us to limit, contingent liabilities. And in terms of maybe negatives that we've seen from the budget is that, debt service costs are still rising at an alarming rate. And of course, we've also just painted that global macroeconomic picture for you. Well, that brings us to the end of the post-budget analysis here. In the next few moments, you will have a QR code that will come onto your screen. And of course, we do value your feedback and we do want to hear from you. So how this works is you take out your phone, go onto the camera mode, hold it onto your screen, it'll come up and you'll have a question or two to complete so that we can give you what you would like to see. That's it from us right here at Net Group Investments. Do have a fantastic day and goodbye.